A very good morning and warm welcome once again to Money Sense. I'm Simon Caudry, and hosting with me this morning is Emil Kalinowski. Emil, a very good morning.
Good morning, Simon.
We are delighted to be joined in the studio this morning by Bill Kelly and Marco Calleja. Bill is the CEO of the Kaya Association and is visiting Cayman, which gives us a splendid opportunity to both welcome him here into the studio at Radio Cayman, as well as welcome him to the island, while Marco is the head of the local Cayman chapter for Kaya. So Bill and Marco, both of you, a very good morning. Warm welcome to Cayman, Bill, and hello again, Marco.
Good morning. Thank you, Simon.
Morning, thank you.
This is not your first time in Cayman, I hear. You've been here a few times.
I have been, but this is the first time I have not come down in January. I'm from Boston, where it's snowy, and I'm now down here when the weather's beautiful in New England, but always enjoyed doing it. It's a quick trip. I get down here on Sunday. I leave on Tuesday, but a fun-filled schedule for those 2 days.
Well, it's not. We do tend to get a lot of people from the Northeast who come to Cayman in the winter months. It's just one of those coincidences, I'm sure. That must be, mustn't it, Emil? They can't...
I believe it has something to do with the weather, Simon.
Okay,
or alternative investments.
There we go. Well, talking of which, you are the CEO of the Kaya Association. Now, that's a few letters joined together, so let's try and sort of explain that to people. Kaya, tell us what it is, what it stands for. What does Kaya stand for? Give us a little bit of background, if you would, about the association.
Sure, I'd be happy to. So the acronym is CAIA, Chartered Alternative Investment Analyst. And as an organizational body or a credentialing-based body, we're 16 years old, so still quite young. If you're in this space, and I know, Simon, you're a CFA yourself, people know the CFA credential to some degree. They may be less familiar with Kaya, and some people think that we exist in competition with the CFA. But we exist because of the CFA, not in spite of it. And the CFA started out very much in the traditional space, stocks, bonds, and cash, very little in the alternatives in the early origins. So AIMA, one of our founders, was looking for a credential that was leaning toward the alternative investment space and couldn't find one. So they went all the way to UMass Amherst. Tom Schneeweiss is one of the founding fathers, deep thinker in this space, had a derivative center at UMass, and AIMA and UMass got together and formed the Kaya curriculum. So it really focuses on the institutional strategies that a sovereign wealth fund or a public pension executive would have in their portfolio. So here I'm talking about hedge funds, private equity, structured products, real assets, commodities. And if used correctly under the lens of education, which is the mission we do, these can be great diversifiers inside the confines of a portfolio.
Now, you started off by saying that this was something that was, the genesis of it was because of the AIMA Association. AIMA, help me out, that's the Alternative Investment Management Association.
Correct, yes.
So they are an industry body that represents the alternative investment management industry, and they approached you and said, look, we need to help build up the skill set of people who are working in this industry. And that's, in essence, what you're saying Kaya's original purpose was.
Exactly. So I think every profession, if you're in the accounting profession, you have your CPAs, medical profession, you need an MD, the law profession, a JD. In the asset management industry, there's no one dominant credential. And if anybody has more market share than anybody else, it's probably the CFA, maybe the CFP. But none of those credentials really go very deep in the alternative investment space. So I view our credential as very, very complementary to other credentials out there. And in fact, 40% of my members and candidates are also CFAs, so the two of them fit very neatly together in terms of learning, education, and understanding in the asset management space.
Can you tell us a little bit about how one goes about acquiring this credential?
Sure. So it's like most credentialing bodies, there's a high-stakes exam involved. It's a two-part exam. It's given twice a year, every March and September. Level 1 is 200 multiple-choice questions. Level 2, 100 multiple-choice questions and 3 essays. Not for the faint of heart. There's 400 hours of study time, so you do have to make a bit of a commitment. And in 75% of the case, it's a second credential. So we get people that are in the mid-part of their career. Typically, the average age of our test takers is about 31 years old. They either have a PhD, a CFA, or an MBA, and they grew up really in the old 60-40 model. 60% of the portfolio in equities, 40% in fixed income. And now they're thinking, hey, these two asset classes are getting more and more correlated, meaning they're going to behave more alike than not, and they need to get uncorrelated returns into the portfolio by using commodities, using hedge funds, using real estate and private equity. And our professional designation is to train people to figure out how to work with these instruments and how to put them inside of a portfolio.
And I guess there's a different angle to this. This is for that you're talking about people who want to be investment professionals learning how to use those instruments. But here in Cayman, and we'll come a little bit in a moment to talk about what role Kaya plays in Cayman. But in Cayman, it's a big service industry for the alternative investment management industry. So people who want to be performing service roles, whether it be auditors, administrators, lawyers, whoever they might be, they'd presumably also benefit from getting that sort of qualification.
Absolutely. So if I sort my candidates and members by the institution for whom they work, the big four public accounting firms are on that list. And we take all comers. And I think like anything in life, it takes a village. So if you work for a regulator, you work for an accounting firm, you're a hedge fund accountant, you're a lawyer, all of these aspects play into excellent candidates to come and take our curriculum. Because ultimately, if you're talking about a single asset class, if you're working for a hedge fund, when you're talking to that allocator, in order to put that strategy into the portfolio, something else has to come out. It's a zero-sum game. So we try to educate our professionals to understand the entirety of the options, not just the one single trick that they have in their bag.
Now, I want to, if I may, to pass over to Marco here, because what we've talked about is the background and the purpose of the Kaya organization. Here in Cayman, then, perhaps you could give us a little bit of context as to who's involved in the association or the chapter locally, what it does locally, so that the audience can just get that local context to understand things better.
Yeah, sure, Simon. I mean, just following on from what Bill said, I mean, I obtained my Kaya back in 2009, exactly for that reason. I'm a chartered accountant by background, and realized that servicing clients that are investment managers working in the alt space, I had about 10 years of experience in chartered accounting, but I didn't have a whole lot of appreciation and knowledge with respect to the specifics of the alts industry. So for me, it was very much a complementary skill set and a designation that was, whilst it's a robust and rigorous exam, it was placed in high regard within the industry. So it complemented my accounting skill set, recognizing the servicing highly sophisticated client base. In a role of opining on financial statements for a hedge fund product, which is investing in real estate, in private equity, in equities, in fixed income. It was certainly helpful to get a deep knowledge in all these different asset classes and the strategies and that. So I obtained my Kaya in 2009. In 2012, we started conversations with with Bill and Kaya leadership about the role that Cayman has in the alternative investment industry and the members that were already present here, like myself, and discussed the opportunity to create a chapter to continue to create awareness about Kaya, provide events for member base here, so whether that's networking events or educational events, and also just look to how better can we create awareness with the universities here, with UCCI, with ICCI, with the professionals here. And going back to your point, a lot of the professionals here are perhaps lawyers and accountants and fund administrators that are servicing that fund product from inception and all the way through its life cycle through to dissolution. Right? So
now, you said, if I'm not mistaken, Bill, you talked about there being 400 hours of study and 200 questions in level 1, 200 questions in level 2. So perhaps, Marco, as someone who took it relatively recently, how off-putting is 400 hours of study? I mean, is that something that the average person, if they're in this industry, can actually achieve? Is it an achievable qualification in that sense? As
an accountant, I'm glad the fact there was examinations both in March and September. So both level 1 and level 2 are you may sit those exams 2 times during the year. It is a big commitment, but any, I guess, accredited designation requires a commitment, right? And I think the curriculum is very relevant, and it continues to be relevant. And I think that's why I decided to pursue Kaya. Is at the time when I pursued it, it was 2009. So this was obviously just immediately after the global credit crisis, and understanding the details of a structured product and mortgage-backed security and asset-backed securities and all of that for me at the time was very relevant. So the investment was worthwhile, and to be honest, it was necessary. It was very much complementary to what we were doing day to day.
And that perhaps is an important point. It's important, but also necessary if someone actually wants to be a professional in Cayman servicing the alternative investment industry. you're going to need some sort of qualification, and whether that be the CFA or Kaya, you can't be shying away perhaps from the hard work that's going to be involved ultimately.
Yeah, I think the industry is a very specialized industry, and when we look at Cayman and how relevant is the arts industry to Cayman, clearly it's the bedrock for our financial service industry. Many people in Cayman are either some way, shape, or form servicing a client. Obviously, there's a number of investment managers that are also based here, but for the majority, in a servicing role. So, as far as credentializing yourself, differentiating yourself from peers, it's an opportunity to also accelerate perhaps your career opportunities, as well as just gaining that knowledge base to be able to be effective in your role.
Marco, how many members on the island?
So Cayman, as you know, is very transient society. We have a number of people that may have obtained their Kaya abroad and are now members based here. We've also got people that obtain their Kaya in Cayman and now are elsewhere. I mean, we have about 90 members in Cayman. That's official folks that have designated their primary location as Cayman. I think the real number is significantly more than that, because a number of people in the industry are here but obtain their Kaya elsewhere, and they may have their primary location, the way Kaya tracks information, based outside of Cayman.
And what about globally? What are we talking in terms of the Kaya membership globally?
So globally, we're going to hit 10,000 members either later this year or early next, which is a first for us. So again, by maybe CFA standards, that's not a number that's going to knock you off your chair. But for 15 years old, to have 6,000 candidates sitting for this exam, 10,000 members in a space that probably has about $10 trillion. Now, to your listeners, 10 trillion may sound like a lot, but the traditional space is another 90 trillion. So we've got about 100 trillion assets under management globally. The alternative space is still quite small. I think as you get into this next round of markets with the pullback on quantitative easing, rates going up, equity markets overpriced, we're going to see a distinct need for more uncorrelated returns in a portfolio, and I think that's where we're going to continue to shine.
Well, that is a almost perfect segue into the break, because we will come back after the break and actually have exactly that conversation. We're going to pose some questions to you. I want to pose some questions to you about various areas of the alternative industry and what your view is of those and what your expectations are for those. So join us again in about 60 seconds as we come back and continue our conversation on the alternative investment industry and the Kaya designation. Give Kathy the old international signal. Never mind. Welcome back. In the second half of today's show, we're going to continue our conversation on the alternative investment industry as we welcome Bill Kelly, CEO of the Kaya Association, and Marco Calea, who's from the Cayman chapter of the Kaya Association. Sorry for butchering that one, Marco. So, Bill, before we took the break, we discussed the general background about Kaya, and we said, well, in the second half of the show, we want to talk about what's going on in the industry, what's going on in the alternative investment fund industry, investment management industry. So rather than pin you down with a specific question, let me ask you generally, what are the current hot topics and current topics that our listeners should be made aware of in this industry?
Well, I think the financial crisis seems so long ago, 2008, 10 years ago. But during that window of time, we have had a lot of non-arm's length market participants, i.e. 4 big central banks who have done nothing but just spray a ton of liquidity into the marketplace. And I think any of your listeners know that if you have a lot of cash sloshing around, it drives asset values up. So you now have equity valuations above fair value in most markets. Whether it's going to go down today or tomorrow, I don't know. But it's fairly valued at a minimum, and interest rates can only go in one direction, which is up. So I think with this false sense of intervention, alternatives have been less in favor, because an individual, a retail investor, could look at an alternative in their portfolio and say, hey, this only returned 8%. The S&P was up 20. Why do I have this dog in my portfolio when it is meant to have an uncorrelated return stream? So if you had a hedge fund, as an example, that was up 20 when the equity market was up 20, you probably have a leveraged beta play that you're overpaying for. So I think the base value proposition and understanding about an uncorrelated return in a portfolio has gotten lost in all of this noise. So I think investors have got to think about their staying power and try to fight back their behavioral instincts. And here I can give you a perfect point that I think some of your listeners may be able to relate to. So Black Monday in October of 1987, the single worst drawdown day in the equity markets, down 20%.
For the record, all of our listeners will be too young to remember that, but go ahead anyway.
It certainly happened well in my lifetime, but the worst drawdown, 20% in one day. Most investors fled the market. But if you ask most investors, even people in our industry, KIs and CFAs, do you know what happened on Tuesday? Do you know what happened on Wednesday? Tuesday after Black Monday, the market was up 5%. Wednesday was up 9%. So most investors fled the market and they missed these big up days. And returns have a tendency to cluster. Some of the biggest drawdown days are clustered right next to the big up days. So I think the very best value proposition for alternatives is the glue to keep investors in the market. Lower your volatility in terms of how much risk you have in the portfolio. Lower your drawdown risk. At the financial crisis, the S&P from peak to trough was down 50%. How many investors had the staying power to remain fully invested during that window? And then were they smart enough to come back in the first quarter of 2008? Unlikely that they were. First quarter of 2009. Unlikely they were going to come back in. So when did they come back in? Some of them are coming back in now when equities are more than fairly valued, and around we go. So I think if you can think about the concept of all the eggs in one basket, diversify across different return streams. When some things go up, some things go down. But you lower your risk and you lower your drawdown, and it keeps you fully invested.
It is a difficult concept, though, to think about diversifying. You said this at the earlier on in your answer there. You said that an investor who's just bought an S&P tracker or bought a world tracker is up, say, 20%. And it's difficult to see the value of something that's only up 7 or 8% when something so simple is up 20%. How does one get over that mindset? How does one persuade someone to get out of that mindset? Because it's a very difficult argument to make. You've got to wait until those bad years, and that seems to be taking ever increasing numbers of days and weeks before it's ever happening.
Yeah, so I think that investing is a very, very long-term game. And I think we have a tendency to look through the lens of every single minute and hour. And thanks to the likes of CNBC and Sky News and Bloomberg, there's immediate price discovery every single waking moment. So if I'm a retail investor with a young child that's 3 weeks old and I'm saving for college, that is happening 18 years from now. Should I be sweating the ebbs and flows on any given day or quarter? So I think you got to think about your assets in conjunction with what's going on the liability side of your balance sheet. So saving for retirement. If you're in your 20s or 30s, you may not retire for another 30 years. So try to rinse away some of these ebbs and flows. And I think if some of those downdrafts have a little bit of the sharp edge sanded off, I think you're going to be better off. Last point I can make is that over the 10-year window, beginning in 2007, going into the GFC, the global financial crisis, up to 2017, that 10-year window, if you had the courage, guts, and intestinal fortitude to stay in the equity markets, the S&P, best performing index, bar none. But if you introduced 10% of alternatives and draw down some of your equity risk and 10% of fixed income, so instead of 60-40 or 50-30 with 20% in alts, you've given up 1% return compounded over this 10 years period of time, but your drawdown risk, your peak to trough drawdown, is down 60%. And the risk in the portfolio is more than cut in half. So these you should look at as a long term. Try not to focus on 1 quarter or 1 year, and look at it in conjunction with what you're saving for and what your goals and outcomes are.
You're almost painting a picture here in my mind of someone who owns a house and says it's never going to get hit by a fire, but I'll pay a small amount of money just in case it does. It's an insurance option in a sense. It protects you against the really bad things in ways that you never think will happen, but when they do is when you need it.
I think that's a perfect example. I've used this. Some of my colleagues don't always agree with me, but you're not going to pick and choose what years you want to pay your hazard insurance on your home. And the other point I make is that people worry about liquidity and price discovery. When we had the housing crisis in 2007, 2008 timeframe, if you look at most people's homes, largely illiquid, highly leveraged, no price discovery, transaction costs were very, very high. And if the housing market in the U.S. was on a T+1 basis, it would have been a goddamn mess. So people would have been trying to sell and flip their houses, and when would they have gotten back in again? But people were pretty relaxed because they couldn't sell. So I think that the fact that we've taken a lot of these sophisticated products, put them into a 40 Act wrapper for ETFs or mutual funds and allow daily liquidity, I think the very value proposition of alternatives has gotten clouded by allowing immediate exit on any given day.
Bill, diversification is clearly coming through in what you're saying. And for my benefit, can you talk a little bit about what we're talking about here when we say alternatives? Some concrete examples. An alternative to bond and stocks and cash is what? And then as a follow-up, if you could perhaps give an example or two of some of the financial innovation, the bleeding edge of alternative in the industry.
Sure. So I think that maybe on a base level, I can use some of these liquid alt funds. So you may have a market neutral fund that is trying to neutralize the beta of the market. And by that, I mean the risk associated with the S&P 500 or some other equity index. So they're going to try to make the return on pure stock selection and take the market risk out of the portfolio. So it should move really not in conjunction at all with the underlying equity market. So if you're going to have a 20% drawdown in equities, hopefully this is down not nearly as much.
So not a different asset, but a different style?
Well, it's an interesting point. So it could be a different style. So you could take equities and repackage them in a market neutral or long short wrapper. And then you could take equities instead of the public markets, go to private equity, which has a longer term investment horizon, usually 10 years. The return stream is usually 400 to 600 basis points above the public equity markets. At least in this market environment, it was a lot higher in different time frames. Real estate is another one. Infrastructure, as I go around the Cayman Islands, I see new roads and buildings, and so real estate and infrastructure. Somebody's got to fund those projects, and investors can get access to those types of projects as well. And that could be more of a substitute for fixed income, where you've got maybe different risks, but a long-term horizon with a coupon to go along with it.
No, go ahead.
And so I was going to move on to the second part, which is a bleeding edge. So the invasion of the digitization in our space is enormous. And one of the comments I've made publicly several times is that every industry is going to face this Uber moment. And I'm sure that there were some cab dispatchers that sat back and say, Uber's never going to last. And those cab dispatchers are thinking something different. The other thing, and your listeners under a certain age are not going to remember this either, the Kodak moment. Kodak does not exist anymore because they failed to see the emergence of what was going on with digital photography. So much data has been created in the asset management space just over the last 10 years. And I actually was part of a conference recently, and I think your listeners might be able to relate to this data. So if I go back to the beginning of writing, this is cuneiform in 3000 BC, 5,000 years ago. If you look at the amount of data that was accumulated from 3000 BC up to 2003 of this year, 5,000 years, the number is 5 exabytes, which is the equivalent of 1 quintillion bytes. That's a 1 with 18 zeros after. So it took us 5,000 years to get there. We're creating this much data today every single day. So it is amazing that the pace and velocity of this data creation, and managers have got to take a step back and say, what is this data telling me? How am I going to use it? How is it going to inform my investment process? How is it going to help me better understand my customer wants and needs, help me distribute product? Because the end consumer of a lot of product now, particularly in the alternative investment space with ESG wrappers, are the millennials. And they're on the receiving end of about $30 trillion over the next couple of decades. And I've got 4 of my 5 kids are millennials themselves. They don't write checks. They've never been inside of a bank. They don't understand regulatory systems. They don't really care about regulatory systems. And they are technology natives. Their views are very different than mine. So you could talk about views on cryptocurrency or blockchain, and I think we may cover some of this in a moment, that it's very hard for me to put myself in their lens and vice versa. So it is very interesting that it's always something new to be dealt.
Well, you've introduced me to a word I didn't know existed, exobytes. And just to pick up on your point, well, and to pick up on your point about millennials, I didn't think they knew how to write full stop, but that's a different. Had to be said. Tell us a little bit, actually. What's your perspective or your view on the future of the alternative industry? And I say it in this context. One of Cayman's three pillars in many respects is the alternative industry, servicing the hedge fund, the private equity fund space. Are you optimistic about the future of the alternative space in the sense that you've talked about this technology advancing? Technology takes away jobs, takes away human involvement. If computers can do things better, why do we need plodders like Emil and myself to do things? Obviously not Emil, perhaps just myself. But what's your position? Are you optimistic or pessimistic about the industry?
Absolutely bullish, and I would have to say that with one of my members, Marco, sitting across from me, but I feel exceedingly strong about it. Just look at infrastructure alone, in terms of the crumbling of infrastructure, the investments of infrastructure, very, very important. And I think when I talk to people in this industry, I try to talk at a level of sophistication or lack thereof that anybody could understand. And I would encourage your readers, Howard Marks, who's a CFA, so now I'm plugging somebody else's brand, he writes these letters that are outstanding, approachable, readable. He just came out with one today, and I have it sitting in front of me because I referenced it in an earlier meeting. It's called Investing Without People. And one of the things he mentioned here is that everything that can be counted counts, or everything that I'll have to look the quote up. It's counting and counts. But put that aside, he talks about the future and long-term investing. And the machine knows what happens yesterday. They know what happens tomorrow. Do they know what's going to happen 3, 5, 10 years from now? And the person is going to be very, very integral. Their job responsibilities and their preparedness for the job is going to change dramatically.
And I guess if people, and hopefully there are people who are listening to this and saying, that's very interesting. How do I get more involved? How do I learn more about this industry? Well, one of the ways to learn more is to visit an event that Kaya in Cayman may put on, or to visit the Kaya website and to take part and study hard and do your 300, 400 hours study and pass the exam. And that way you'll learn a lot more about these things, I guess. And I'm sure you advertise events that you have going on, and people can always approach you, Marco, and your colleagues and learn more about it that way.
That's right, Simon, and they're advertised on the website, which is www.caia.org. So welcome everyone to have a look at the website, and all the information is on there. Thank
Fabulous. Well, look, as is always the case on Money Sense, our time is too limited. We are out of time. So Bill and Marco, it's been an absolute pleasure having you on our show. Thank you for your insights, perspectives, and hopefully you have helped demystify the alternative industry for some of our listeners. As a final note before we leave, just wish to thank once again all of our listeners and remind you that today's show will be available as a podcast on the CFA Society Cayman Islands webpage. I encourage you, if you have a question or topic, to email us at moneysense@candw.ky or send us a tweet at MoneySense Radio. With that, thank you once again, goodbye, and please do tune into Money Sense in 2 weeks' time.